If history is any indicator at all, fewer than 1% of Americans will be audited by the Internal Revenue Service in the coming year. Of that very small number, some of the audits will be randomly selected, but many are actually triggered by actions that taxpayers themselves take. So in this video, I will walk you through the biggest audit red flags that almost always guarantee that your tax return will have a very high chance of being selected for an audit by the IRS. The tax deadline is April the 15th, and this is the very first step that you need to pay attention to. If you know that you're not going to meet the deadline, the number one thing I believe you should do is file for an extension. It is free to do and it is extremely easy. The IRS doesn't want to know why you need an extension. They're not going to ask you for your reasons or your excuses. It just wants to see a piece of paper saying you need more time. That's all. And it will automatically grant you the extension. If you do this, you will avoid late fees, you will avoid penalties and interest on the tax liability if you have one. That is a good enough reason, right? If you need some help figuring out how to file an extension, there will be a quick video on my channel soon. I will show you exactly what you need to do, so make sure you stay tuned. If you do want to try to meet the deadline and you're just not too careful, I want you to know that making an error on your return may serve as a red flag for the IRS to audit you. There is no guaranteed way to avoid an audit, unfortunately, but there are some red flags that you can avoid, so you can reduce your chances of being audited by the IRS. In today's video, I will share with you 4 red flags, 4 areas that may trigger an audit. You're going to want to avoid all 4. Typically, taxpayers know that overvaluing home office expenses and donating goods are red flags to auditors. Simple math mistakes and failing to sign your tax return can also trigger an audit. But the first and the biggest red flag is your income. It's the income that you claim on your tax return. Generally, your earned income will be reported to you and to the government on all applicable forms, for example, on your W-2 or any of the 1099 series forms. If the income that you report on your tax return does not match government records, and they do compare what you claim with what they believe you should be claiming, you could find yourself facing information requests and even fines. By the time the IRS reviews or audits your return, it already knows what income amount you should claim on your tax return. It's always best to take your time to ensure that all your income forms are accounted for and the proper totals are included on your return. Also be aware that there is no form for some taxable income types, for example, for proceeds from renting your vacation property, meaning you are responsible for reporting it on your own. So make sure that you take note of that. The second red flag I want to talk to you about are your investments. In most situations, selling an investment is a taxable event in the year of the sale. To understand what you owe the IRS in taxes, you will need to know and report when and what you paid for the investment and when and what you sold it for. Financial institutions are typically required to provide this information on Form 1099-B, but there are situations when you are responsible for supplying that information to the IRS. For example, it is applicable when you sell stocks, including real estate investment trusts acquired before January 1st, 2011, mutual funds, exchange-traded funds, and dividend reinvestment plans acquired before January 1st, 2012, and other specified securities, including most bonds, derivatives, and options acquired before January 1st, 2014. In other words, it really is important that you keep good records of all investment purchases and sales. Typically, you would have access to it online through your brokerage, and just be sure to report not only the transactions that your financial institution reports on your 1099 form, but also the transactions that you know you are responsible to report independently. This will help you feel comfortable that you're not over-reporting or under-reporting your taxable income. This is truly the safest route. Those of you who are sole proprietors or small business owners, You're going to want to know how long you should keep your documentation. As a rule, it's best to organize all of your paperwork, even if you do have a CPA, and just make sure that you know where it's located for at least 3 to 5 years after the fact. Red flag number 3 are tax deductions. The IRS scrutinizes tax deductions to discourage what they refer to as abuse and, of course, unsupported claims. Think of charitable or other itemized deductions, for example, which could be a red flag if they're especially large or quite unusual. The IRS compares the total of your deductions to similar taxpayers within your tax bracket. And if you stand out to them for whatever reason, they will likely investigate if the amount is large enough, and it is up to them to decide if it's large enough. So be aware of the documentation rules for charitable contributions and be sure to keep detailed records to support every single deduction that you claim on your tax return. This is extremely important, so make sure that you have really good records. The IRS may decide to disallow a deduction, which would cause penalties, fees, and a ton of problems. The 4th red flag I want to talk to you about is incorrect information, or what might appear to be as incorrect information, in other words, mistakes. Let's all agree that the simplest mistake can raise a red flag. A misspelled name, this could be an incorrect social security or tax ID number, or even a missing signature. It can cause substantial problems and delays in processing your tax returns. The IRS may see a simple mistake and start looking into your prior year tax returns, and it may snowball quickly into something that could have been avoided in the first place. So do double check your return before you submit it. In other words, review all the fields throughout your returns for accuracy, and keep in mind that even tax preparation software doesn't always catch mistakes. So ultimately, you're the one responsible for ensuring that your information is correct. And by the way, if a CPA prepares your return, you are the one ultimately responsible for it anyway. Every question on the tax return form should have an answer. Even if that answer is 0, don't leave it blank. Make sure that you've completed every single line item that is relevant to you. An unintentional oversight could get your return some extra attention that you really don't want. Ultimately, it is important to understand that your odds of an audit are fairly small if you are a W-2 employee and if you don't have a business or unusual investments. In general, businesses and individuals with earnings in the multiple millions of dollars are more likely to be audited. But this year, the tax commissioner did say that those with annual income of less than $400,000 may very well be selected for an audit this year. So anything is possible. I wouldn't count on a lucky chance. Thank you for watching this video. I hope that it was helpful. Please remember to subscribe to my channel, give this video a thumbs up, and share it with those who may be interested in this type of content. It really helps support me here. And of course, I appreciate your time. Thank you for joining, and I will see you in my next one. Have a great day. Take care.